macroeconomic turbulence of 2023, characterized by rising interest rates and geopolitical uncertainty, has dimmed the deal activity. So, what kind of companies do you see private equity investing in going forward?
Sure. Monica, thanks for the invitation. The big thing about private equity at the moment, yes, deal count has come down since 2022 and 2021, but actually it's still quite active in that it's just at the levels of 2019. The types of companies that private equity will invest in, there are three key attributes. One is annual recurring revenue, so they like a stable income structure, good predictable income, they like good growth prospects and good margins. So if companies that are ideally ticking off all those three boxes would attract private equity interest.
So coming out of this subdued market, do you expect any significant changes in the habits of the private equity fund managers?
The answer is yes and no. On the one side, the no would be they're going to stay disciplined on their investment thesis and their investment appetite. So if they're disciplined around going for companies with a high AR, annual recurring revenue, or strong margins, they're going to stick to that, and they're not going to weave away from it. The difference, though, however, will be in their emphasis on their existing portfolio. They're going to invest a lot in creating value, strategic and operational value, because they no longer have the financial leverage as a key mechanism to create value. So we see private equity morphing and becoming much more dynamic owners and active owners in those businesses.
Okay, that's interesting. Talking specifically about the tech industry now, in Europe alone, startups are scampering to find new means for an exit. Moving forward, and as mature startup valuations become more realistic, can we expect the private equity buyouts to turn into a more common exit avenue for the European tech?
Short answer, yes. Private equity invests, one of the key sectors is in technology as well as commercial services and healthcare. What we're seeing is the valuations of these businesses, the VC-backed businesses, are under pressure, in part because the funds available to VCs have been diminished. The fundraising has been under pressure, so they've had to orphan some of their businesses while they're focusing on others, and those represent good opportunities for private equity. Importantly, however, a lot of them won't be standalone businesses owned by private equity. They'll probably be add-on acquisitions to pre-existing PE-owned businesses that can take on board a struggling asset, or one not necessarily struggling, but probably still in cash burn mode, that will hopefully create strategic operational value to the acquiring portfolio business.
Okay, thank you for that. And what is the industry outlook for 2024 and beyond, maybe?
The decline in interest in private equity deal activity is driven by two things. One is the high interest rates, and the other is economic uncertainty. If we look at interest rates, we don't expect them to come down rapidly. If I use the analogy of a table mountain, it's going to go up, stay up for a while, and go down after a few years. That will keep activity subdued somewhat. Similarly, the economic uncertainty, a lot of things happening in the world, geopolitical challenges and economic challenges. We think that uncertainty will keep interest in deals subdued, not to the level, not the decline we've seen, not the continued decline, but in 2024 we think deal count will level off from where it is in 2023.